This is the everything bubble. It is a new paradigm which will be written into economics textbooks in the future. We can write about the absurdity of the monetary system. We can study the contractions as a result of these policies. There is simply no way out of this mess. You came here for the truth. Today we are going to look at several charts, so let's begin. This here is the big news. World stocks and world bonds are going up in sync with each other. This chart here is showing you over the past year. And also in sync with that is the G3 central bank balance sheet. Obviously, these are all tied into each other. You cannot deny that. Though some people tell me that I'm a liar, that this isn't real, this is simply a fact. I'm reading the information for you. Previously in history, we had something called cycles. And that would mean that certain asset classes would be in a bull market and other asset classes would be in a bear market. And perhaps that would reverse course in due time. That doesn't exist anymore because we have central bank policies that are trying to reverse that being a possibility. They do not want to have any deflationary environment, so they are headed in with their only two policies that they have, setting interest rates and quantitative easing. And so they do this to the maximum degree that they can. It takes a little bit of time, sometimes over the years, to engage in a complete destruction of the currency. But of course, that is the end policy. So this is what they're doing. This is what they're trying to exact on to the public. And they're doing a good job of it. Because right now, today, there are no more cycles. There is only this ascension, this climb that we've been seeing. And it goes against all natural market forces. But here we are today. Hey, look, I understand. You're invested in Amazon. You're making good money. Please, by all means. I'm not suggesting otherwise. I'm just trying to point out what I see. That's all. All right, it's official. Debt tops $20 trillion for the first time. It jumps a whopping $317 billion in one day. That's right. 20 trillion has finally been crossed and 317 billion in one day. Let's look at the chart. Look at that. So it flatlined for a long period of time. Not a penny was spent over this entire period. Okay, totally realistic. Several months. And then up it goes in a single day. They hold it at this level. I mean, come on. Does anybody believe that? Does anybody believe that they didn't spend a dime for this many months? No. This number's fake. The 20 trillion is fake. We know it's much higher. But it's just good to see that finally crossing over that $20 trillion mark. Congratulations. Excellent work, everyone. Excellent work. There are too many promises that can't be kept. So let's take a look quickly at this. The total IOUs in the US as a percentage of GDP. Government debt, private debt, pensions, and it goes on. Guess what? It's rising. Does that surprise you? Well, it's okay. Because individuals say that's okay because the stock market's rising and the economy is doing better. So surely you can have more debt. It's not an issue. I don't agree with this at all. I think this is a very ridiculous policy. If more and more debt was the answer, why wouldn't they go in the absolute maximum amount of debt? Why, if it is owed to itself, that's the claim, then there really is no reason to worry. And therefore, let's just keep the party going. So why wouldn't the Fed just print up, instead of just printing $16 trillion one time during the financial crisis, why not print $16 trillion every single day and give that money to the citizens? They would go out, they would buy this new iPhone 8, they would go buy 2 of them, maybe even 3 of them. They would buy more televisions, they would buy more cars, they would buy yachts and boats and vacation homes and everything else. Why not? I mean, why not? I'm asking. That's not a rhetorical question. I'm asking. If there is no issue with printing up money and giving to everybody, going into heavy amounts of debt, public works projects, just rack up the whole deficit, make it terrible, bring the debt up, everything. Why not do it? That's a question. Promised versus reality. Now, there is a claim here that over time you're going to get this average return of 7%. Have no fear. If the market goes down, just keep your money in and you will see it rise again. I've demonstrated over and over and over and over again, especially first documented in my book. I've covered it here on the channel so many times. All right, so let's look at this. So this is basically up until present day at this point here. And they're promising an average of 7%. So that would mean that everything basically has to go fine from here on out, and there would be only little dips along the way, and that would have to continue for the foreseeable future. But of course we know that isn't the case. It's just not going to happen. If I scroll down just a little bit here, promised growth, actual growth, the return gap, actual S&P, it basically goes through all of these things. And you're never going to hit, the point I want to make, you're never going to hit that. There are periods of time where you might actually be, instead of 7%, you might be at 70%. And you might think to yourself, I'm doing a hell of a lot better than what these individuals are. But guess what? The general person, the average investor who's invested in mutual funds, who has their bonds and their stock portfolio, they're not going to hit that for a long period of time, because most people, they just let it ride. They just let it ride. They put their money into their portfolio and they say, look, I'm 40 years old. I don't need that money till I'm 60. I know that it seems a little bit frightening right now, but where am I going to put my money? Maybe I'll put a little more into cash. That's right. I'll put in the money market funds and everything's going to be just fine because those are more stable. But things aren't looking so pretty anymore. Real rates dipped down recently as inflation resurrected from zero while nominal rates held steady. So I don't know what this is trying to get into, but whether we look at, by the way, talking about Germany here, look at the reason I show this, look at how much negative interest rates have found their way into the system. The concept of a negative return on your money that investors are signing up for, and the fact that it's selling trillions worth, is when you know this market is, number one, rigged, and the fact that this doesn't make any sense anymore. So on one hand, you have them taking on the riskiest of risky assets, so-called assets. And then on the other end, they're taking this garbage. And it's not as if, okay, there are a lot of derivatives out there, but the fact that there are trillions of being purchased of these negative return, I mean, that's what you're going to get. You're guaranteed, you put let's say $1 in, okay, I'm going to get 99 cents back. Why would anybody do that? Why would any sensible person do that? Well, the fact is, it's not people who are doing this. It's all of those on the inside. It's all the big corporations. It's the central banks. It's everybody else. They're the ones buying this garbage, not you and I. Measuring the bond bubble, the real rate to growth ratio in Germany. Just wanted to show the fact that GDP picked up and inflation moved from 0 to 2% in a 9-month period. Okay, let me move on quickly here. U.S. investor optimism going from 96 to 2017. You know what? Things are great. Things are really great because, in fact, they are better than just before the financial crisis. And you can see that right here at 138. And we are now approximately at the dot-com boom, when everybody and their grandmother thought that this would be the best time to dump in their money. Now is that time, apparently, despite the fact that we've had this rise all the way through. That's okay. That doesn't matter. All that matters is that just like so many people watching this video right now, unfortunately, the investor optimism is at almost record highs. A lot of people who have criticized me, not the good core subscribers that we have on here, of course. I'm talking about the individuals that have a lot to say and not a lot of substance, are suggesting that now is the time to dump all your money in to the stock market. Just go ahead because the stock market's rising. And if I've never in my life have I heard such a terrible reason to invest. Truly. I mean that truly. Total outstanding credit card debt, 1986 to 2017. Lo and behold, we're basically at the same level yet again. We are talking about $1 trillion worth. $1 trillion worth. There was some amount of deleveraging, possibly bankruptcies and other things, but it's come back. It's come back. Just like in Canada, what has happened, a lot of people are able to just get home equity loans, they're able to get second mortgages, and there you go. You can pay off your credit card because the interest rate is lower on one of these mortgages, so why not do that? And then you can buy that iPhone 8 if you'd like. What a great plan. So I'll leave it at that. All I'll say is, if you found this video informative, then please give me a thumbs up. I do appreciate everybody who subscribes to this YouTube channel and join the other 66,000 plus. If you haven't already, please hit the subscribe button. I do videos every single day, basically, sometimes more than one per day. So I hope that you will join me here on this channel. And if you found the video informative, I know you will find my books, The Money GPS and my new release, Global Economic Collapse, even more informative. You can flip through those books if you'd like to. That links are in the description below. Take care.